Okay, we'll now take a look at exercise 15.1 on page 896. And we're dealing with an operating lease in this situation. And this is the kind you're probably most familiar with. Just a typical tenant-landlord situation. It's here, I don't know that that's what we have here, but that's what an operating lease is. It's a most common example probably is the tenant-landlord agreement. How that traditionally works. Let's read through it. On January 1st, 2016, Nath Langstrom Services Incorporated, a computer software training firm, leased several computers from Computer World Corporation under a 2-year operating lease agreement. The contract calls for 4 rental payments of $10,000 each, payable semi-annually on June 30th and December 31st each year. The computers were acquired by Computer World at a cost of $90,000 and expected to have a useful life of 6 years with no residual value. Okay. We know this one is an operating lease, you guys, but I thought we would look at the criteria to see if this lease qualifies as a capital lease. And you'll see that it does not. Now here you wouldn't have to complete this step because they've told you it's an operating lease. But a lessee should record a lease as a capital lease, meaning it's essentially a purchase, if it includes a non-cancelable lease term. I think we have that here. But it has to have one or more of the following criteria met. The agreement specifies that ownership of the asset, in this case the computers, transfers to the lessee. That's not the case. Those computers would go back to Computer World at the end of the lease term. Or the second one, the agreement contains a bargain purchase option. It does not. There's no option for Nath Langstrom Services to purchase the computers at a discounted rate at the end of the lease term. The non-cancelable lease term is 75% or more of the expected economic life of the asset. Well, the useful life is 6 years. The lease is for 2 years, so that's only 33% of the useful life of the asset. And then the present value of the minimum lease payments is equal to or greater than 90% of the fair value of the asset. Well, the fair value of the computers on the day they were bought or purchased by Computer World was $90,000. Well, if you just add up the 4 rent payments of $10,000 each, that's only $40,000 without even discounting them to their present value. So none of those 4 criteria were met, so we know for sure it's an operating lease. Again, you knew that before you looked at it on this problem. But I thought that was worth going through. Okay, so now let's go to the requirements for this exercise. It says prepare the appropriate journal entries for both A, the lessee. So let's start with that. Lessee entries, which the lessee would be the renter or the tenant. It's the person, the group leasing the property, right? Okay, so the first entry made by the lessee, both of these would be in 2016. The first one would be made on June 30th. When they make their first lease payment. And this is going to be very similar to entries you've seen in the past. They're going to debit rent expense, the rental charges on the computers, $10,000 4 times. Okay, and then of course the account to credit would be cash. Just like if they had paid rent on an office building. Okay, the next entry to be made by the lessee will be on December 31st. And it's the same entry again. They're going to debit rent expense, credit cash for the amount of the lease payment, $10,000. Okay, so that takes care of the entries in this case for the lessee. Now let's look at the entries for the lessor, the actual owner of the computers. If you'll notice, I went back and put in the name of the company so there's no confusion over which company was the lessee, which company was the lessor. Okay, now these entries will be made in 2016 as well. So we've taken care of part A from the required. Prepare the appropriate entries for both A, the lessee, we've done that part, and B, the lessor from the inception of the lease through the end of 2016. They want us to use a straight line method for depreciation. And remember, Computer World is the owner of the computers. So they would make an entry on June 30th as well. Of course, they would debit cash. And you probably guessed it, they'll credit rent revenue, not revenue rent. Okay, same thing on December 31st. They're going to debit cash when they receive the rent and credit rent revenue. Okay, you're familiar with this. These are the entries that will be made by what we typically call the tenant, but here they use lessee because tenant more refers to an occupant of a building and landlord to the owner of the building. Here we're dealing with computers, so we use lessee and then lessor, right? The company leasing the computers out to another party, and the company leasing the computers from the other party. Okay, the cash received would be rent revenue for the lessor. The cash paid would be rent expense for the lessee. But now the computers also belong to Computer World, so another entry on December 31st, we're going to debit depreciation expense because they're going to be the company that depreciates the computers. They actually own them. Well, the computers cost $90,000. They say use the straight line method. There's no residual value at the end of 6 years, but the useful life is 6 years. So that's just going to be 90,000 divided by 6 gets us 15,000. And we'll credit accumulated depreciation for the same 90,000 divided by 6 years, $15,000. Okay, now that takes care of the lessee and lessor entries on an operating lease. So that's kind of our starting point. We're going to look at several different types. If you have any questions, please be in touch. After working this one, I don't think you'll have any problem with the exercise 15-1 on the Connect Plus site. Thanks a lot.